Hello, good morning friends. Last year in class 11, if you remember, we have learned about the sources of finance. In that, we know that mainly ownership capital and equity share capital. Now, in 12th standard, in accounting part 2, you have the first chapter. That chapter is accounting for the share capital. Theory of share capital we have learned. So we will recapitulate once again the meaning and the types, that is preference share and equity share, and then we switch over to the accounting journal entry for the share capital. So today in class we are going to know once again and revise the portion what that share capital means. The meaning of the share capital, it says that capital of the company which is divided into the transferable small denomination. What it means? That small denomination you make of rupee 1 or rupee. As per the present scenario, the share capital value may be 1 rupee face value, maybe 10 rupee or maybe 100 rupee. So that particular small denomination you make and you accumulate a huge amount, that is what collectively known as a share capital. Each such unit is in the denomination is known as a share. Individually you called it as a share. The person who purchased the share known as a shareholder, and the accumulated total amount for the company is known as a share capital. So here the share capital is a liability for the company. We will write as per our accounting equation on the L, that is C plus L is equal to A. So your C part, the capital, share capital, is a liability for the company, and the share is an asset for the person who invested into it. It is a movable as well as transferable for investor. For investor, it is a very easy, very liquid asset. Anytime he can sell the shares into the market at prevailing market rate. So person can easily transfer, person can easily move. It is just a document. Nowadays not even in the physical form. It is in the demat form. So it is movable as well as transferable for the investor. So this is what all about the share meaning, that the total capital accumulated by the company in the form of a small denominator as a share, and total figure share capital. The second point, that is the types of shares. The shares are of two types. One to be called preference share, another to be called equity share. We begin with the preference share. See, the word itself says preference. You are giving, both are of a ownership type of share capital, in that preference as well as equity. So the preference share, the word itself says that preference is given for the shareholder for getting dividend as well as at time of liquidation. The preference will be given to them for getting their capital invested amount. That is what known as a preference share capital. Here the shareholder, they always have a preferential right towards the receiving a fixed rate of dividend as well as the repayment of capital at the time of liquidation of the share. Here normally the face value 100 rupee or 1000 rupee, whichever decided by the board of directors. There are the various types of preference share. In preference share you have the different types. The very first is, that is the cumulative and a non-cumulative preference share. What the word cumulative? Cumulative means it goes on accumulated if the payment of dividend is not done to the preference shareholder. For an example, in 2018, if there was a no profit and company was unable to give dividend to the preference shareholder, suppose the 8% is the rate of dividend, then in 18 you have not given. It means that in 19 you have to give 8% of the 18 as well as 8% of the 19. So it goes on cumulate, it goes on adding into the total amount of dividend to be given. And non-cumulative means no such preference, no such priority given to the investor, that is preference share holder. The second is participating and non-participating. The word says that participate. If the shareholder are supposed to get 8% dividend and equity shareholder are getting more dividend than that 8%, then such shareholder have a right to participate in the higher rate of dividend which is enjoyed by equity shareholder. So that is what participating, and no such special benefit given to be called non-participating. The next is redeemable and irredeemable. At a particular time period when the amount of preference shareholder is to be compulsorily be redeemed means to pay back. You are giving back and company reduce its liability. That particular thing to be called that redeemable preference share, and irredeemable means no such special provision is mentioned in that preference share. The next is that is the convertible and non-convertible. Convertible means ultimate object of every investor is to be the owner or to get that ownership shares. That is what a equity share. But initially when the company is new, the management is new, there is no history of the management and the company, the investors are little bit reluctant to put their money at a 100% risk. Equity shareholder are bearing the total risk of business. So initially for the safer side, they invest into preference share. After few years, when company is growing and doing good and performing better and better, now these shareholders want to convert from preference into the equity share. So that facility given to the convertible preference share holder, and non-convertible means no such specific priority is given. So this is what all about the preference share. Now preference share, if company want then only issue, if company don't want then preference share is not a compulsory part of the share capital which company must have. That is what only for the case of equity share or ordinary share. So preference share, if company management want then only they go for this particular type of share capital. Now the second, equity share capital. Equity is also known as an ordinary share and also considered as a principal share capital. Why such an importance is given that principal share capital? It is compulsory to issue. For every public company, in that commencement certificate, it is compulsory to have minimum subscription, and that portion of capital, if company unable or fail to collect from the general open market from the investor, then company may not get even the commencement certificate. So that much importance is there for the equity share capital. So it is known as a ordinary. Ordinary means common. Without this type of share capital, company cannot exist. So it is so common. It is equity share or a ordinary share or a principal share. The main character of the shares are that the shares which are not preference share. How you can identify the equity share? The share which are not a preference share means no such limits are there or a preferences and priorities are there. They are the very simple, common. That's why known as a ordinary share or equity share. Against this, see here the preference is there. These people are not getting preference. Then they should get something different. So what different they are getting? Here they have the voting right. As many as shares, equity shares you own, that much voting right you have. So that is what the voting right you have. Participation in the management, that priority you have. Attending that annual general meeting is there, and like that you become the owner. You are the investor of the company. The second, you get the dividend. Dividend, that is what part of profit. If profit is there and remain after distributing dividend to the preference share, then and then only you will get the dividend in case of equity share. So if no profit, no dividend. If there is a profit, you will get the dividend. And that too at last. After payment to the debenture holder, their interest, and the preference shareholder, their dividend. Now if something remains, then only you get the dividend. Here is the last payment of dividend also, as well as the capital at time of liquidation also. When the company liquidated, what that liquidation means? That company going to be wind up. All assets are sold out. Out of that, all the liabilities are paid, and at the end, if some portion remain, then only at the end the equity shareholder will get their funds back. Here the face value of the equity share may be, as per the present scenario, it may be even 1 rupee or a 10 rupee or a 100 rupee as per the management decision. So in this manner, company has to collect capital. Capital may be collected in form of preference share or may be in form of equity share. Now the per amount that what company has to collect, a company not going to collect the total amount at a stretch, the 100 total. Company split that amount into the various installment, and in the installment company collect money. For an example, 10 rupee company has to collect, then out of that 2 rupee company collect at time of application, 3 rupee company collect at time of allotment, and 3 rupee at time of, you can say, the first call, and the remaining again 2 rupee at time of final call. So in this manner, the 10 rupee to be collected by the company in different installment. That what journal aspect we have to learn in this chapter as the accounting of equity share entry in the company's books of account. Step by step, we will be learning how the accounting to be done. So this is what today's class about share capital, its meaning and the types. Thank you.